business. David Winters, he's a veteran international value investor. He's CEO of Wintergreen Advisers and manager of the Wintergreen Fund. That particular fund, it ranks in the 99th percentile for its performance year to date among its peers. And David is here now on set with us. We're going to be joined also by the folks on our markets desk, I should say, Dominic Chu and Adam Johnson, to talk with him as well. And David, I really just want to get straight to your picks. That's what people want to know about from you, especially when your fund is in the 99th percentile for the year to date. And what we're going to kind of do over the next couple of hours is group them by theme. Very roughly, but group them by theme. So the first thing we're going to look at is Switzerland, because you have a number of picks in Switzerland. And the first one is Richemont jewelry company, the world's largest jewelry company. Now, we just heard from our Michael McKee, our economics editor, about the crummy retail sales here in the U.S., especially when you're talking about a luxury jeweler. How is this company going to be doing going forward?
Well, the interesting thing, Julie, is that the world beyond the 50 states is doing much better than we are, and especially the Far East.
I was going to say Europe. I don't know about Europe falling in that equation.
Well, but certainly the Far East is. And I think where Richemont is shifting its focus is to developing their business in the Far East. And, there's a couple billion women out there, and they want everything that women in the United States have. And they're going to work hard to get it.
David, could I ask, what makes them want to shift their focus in this economy, in this global economy? What are they seeing that perhaps others are not?
Well, I think that you have economic vibrancy in the Far East that the rest of the world lacks. And part of that, Mark, is because there was a financial crisis in Asia 10 years ago.
Right.
And they learned a lot of the lessons and set their balance sheets in good order. And you've got the underlying growth of the region. So it's a good place to do business.
Now, I was looking at the company's most recent comments about earnings and what's going on. It seems as though they are seeing some lower production. They're cutting back on production. At the same time, there's a stronger Swiss franc. So costs are actually going up for Richemont, even if it is experiencing better sales. But is that a concern at all for you?
I kind of try to think long-term, Julie. And I see that this is a business that I've followed for many years, and it's had its ups and downs, but over the longer term, it's gone from strength to strength to strength. And Cartier, for example, is the one great global jewelry brand, and people love it.
Hey, Dave, I got to jump in here. I can't resist. If you're talking Cartier and Richemont, of course, I got to ask you about Tiffany. That stock down a couple percent, trading about 15.5 times, and 35% of their sales also in Asia. So for people who are maybe not wanting to go as far afield, is Tiffany a legit way to play it as well?
I think Tiffany's a great brand name. I mean, one of my best friends, only buys her jewelry at Tiffany. So, it's a great company. And what's interesting is you've got Swatch, which I think we're going to talk about soon, which has done a deal with Tiffany to supply them with watches. So, I think longer term, these are good brands.
Just a quick question on valuation as well, since you're a value guy. Tiffany's also cheaper than Richemont. If you look at the forward PE, Richemont at 18, Tiffany at 16.
Well, I think you also have to adjust. One of the beauties of Richemont is it's super conservative. They've got a great balance sheet. So if you start adjusting the balance sheet, I think either way you'll do fine. I think the reason we like Richemont, it's got an even greater global reach. And, our view is that's where as Wayne Gretzky would say, that's where the puck's going.
And David, our Dominic Chu's in the newsroom. Dom, you have a question as well?
Well, you got right in there because you stole my thunder with Swatch. I want to know about Swatch because we talked about it the last time you were with us here in the newsroom about the idea of these guys basically catering to different types of niches. And like you said, with their Tiffany agreement here, is Swatch a company that's maybe spread itself too thin, or do you think that diversity in products is actually going to help them going forward?
Well, I think, Dom, you're right on as usual. Because they have the low, medium, and high end, they've been able to capture different elements of the market. And in the Far East now, what's selling is the medium, not the super high end. And so with helping Tiffany update their watch brands, hopefully it'll revitalize Tiffany and be something that the analysts haven't even considered, Julie, in a gem inside Tiffany.
David, can I ask you, because it sounds like you're talking about company diversification. They decided that perhaps even before the global economic downturn, that they weren't going to put all their eggs in one basket, that there's got to be different groups of consumers that you have to appeal to. They may want the Swatch brand, but maybe at a lower level as opposed to the high-end level.
Mark, you're right on the nose. I mean, I think that the smart investors, and especially today, are continuing to invest for the long term to build their businesses. And it's the same thing as an individual investor. How do you build your portfolio when people are not buyers and stocks are cheap? And so the Swatch people started 20 years ago or longer in the Far East, and now it really bears fruit.
There's a significant switch at Swatch, obviously, since you last talked to us, and that's the death of the founder of the company, Nicholas Hayek. Now, the CEO position doesn't change. It's his son. The chairman becomes a chairwoman. So does that affect your view of the company at all? Are you satisfied with the succession that they've laid out?
I think, they've done such a fabulous job as a family that I am completely willing to give them the benefit that I think they'll do a great job.
I want to get to your other Swiss pick that you talked about last time. It's actually down just a touch since we last talked to you in mid-May, and I'm talking about Nestle. Obviously, a very different kind of company here, and one that investors want them to spend some of their money.
Yeah.
So how do you think they should be spending their cash? Do you want some acquisitions out of Nestle?
Only if they're smart acquisitions. Otherwise, buy back your stock, raise the dividend. What's so interesting about Nestle, Julie, is they have this huge cash pile and the 29.9% stake in L'Oreal. And they've been brilliant investors over the years. I think Alcon was a teeny investment that became worth billions.
$28 billion they're going to get from that Alcon investment. So that's what people are focusing on. So what would be a smart investment for Nestle to make?
Well, I think it's harder because they're bigger today. And I think that they just have to keep growing that company and doing a good job. They've recently said they're going to grow organic growth 5 to 6%. That's pretty amazing.
That's significant, isn't it?
Yeah, and they're everywhere. And it's a global currency, multi-currency play. So you have a natural hedge. And do you remember, I remember chocolate bars used to cost 15 cents.
Yeah, I remember that.
And so, we think that they have a lot of latent pricing power. And Nestle, if you strip out the cash, is 11 times earnings. It's cheap.
All right.